My name is Nick Hodge. Today we're going to talk about 3 questions that I ask every company that I'm potentially going to invest in or cover in my newsletters. Those newsletters are all listed here. Outsider Club is a free daily. Resource Stock Digest is a free resource for retail investors looking to invest in the resource space. We cover a lot of quality stories there and give free information and interviews with executives and post content from other outlets as well and have third-party experts on there. And then I run some paid services. Early Advantage is a weekly paid service focusing on early-stage speculative investments, sector agnostic, although I tend to lean towards the resources a bit. And in Nick's Notebook, I provide private placement opportunities for accredited investors to invest privately in primarily resource companies again. So at these conferences, there's a lot of companies, and it's tough to, I think, figure out, where you should put your capital. It's when the companies are here, they're promoting themselves. Obviously, that's their job, and they all have the best management team and the best project and the highest chance of success when you're talking to them. So how do you separate the wheat from the chaff? And so the series of questions that I've come up with, there's 3 overarching questions I'll discuss today, and then each of them have a subset of questions that you can branch out and ask companies. But these are the questions that I've determined really get to the heart of the matter in evaluating a resource company, and specifically a junior resource company. Because I'll be honest, it's a tough space to be in. It's inherently risky, and the way some companies structure themselves, it honestly doesn't lend a very good shot for retail shareholders to make money, albeit, if you hold cheap shares, you can make some money. So the first question you really have to ask is, what's the share structure? And I've put a picture of a guy sweeping up some, cheap paper here, because you really want to find out who owns all the cheap paper. I think that's the first question you want to ask, and it's really important. So when you're investing in a company, or you're talking to a company, or you're looking at the slide deck, they normally have a share structure slide, and it'll say how many shares are outstanding and how many warrants are out, how many options, and what that translates into fully diluted. But I think it's really important to find out who owns what shares at what price, and that's something that's typically not in the slide deck, and that information is provided in something called a cap table. So you want to ask the company to see their full capitalization table. You want to know who owns what shares at what price and how much, and how many warrants do they own, and when do those warrants expire. So I've put just a quick example in here. These were 2 companies that are presenting here at the show, or at least at booths here, that requested a meeting with me. And the first thing I do when I receive a request like that is I look at the share structure. It's the very first question I ask. So here are 2 companies trading around a similar market cap. One's valued at $8 million and one's valued at $10 million. At Company A there only has 38 million shares outstanding, while Company B has 135.3 million shares outstanding. And while they have similar market caps, you can see how the share price is differentiated there, because obviously the company with more shares out has a lower share price to equal that same market cap. So, right off the bat for me, I would view Company B as not having a tight share structure. In fact, I probably wouldn't even take a meeting with them unless, I knew the management had a very strong track record, or I knew the project, or I had some past connection with it, because a share structure like that makes it inherently tough for the share price to appreciate. While it may trade a lot of volume, there's also going to be a lot of selling, especially if there's cheap shares out. And then the problem can be compounded when you add on warrants. So these are the STEM questions that you should ask from the first question is, what's the share structure? Well, you should also ask, at what prices were shares sold to raise capital? If there's a lot of what's called cheap paper out there, at, even below a penny or a couple of cents, then those people who own those cheap shares are inherently incentivized to sell earlier rather than later. I mean, it's human nature. If you have 1 cent shares and the stock goes to 5 cents, well, that's quite a smart return, and it's tough to pass up selling even a little bit of your shares to bank that profit. And so people that have those cheap shares selling onto the volume to typically retail investors is what creates churn, or what creates the stock just staying in one place and not being allowed to appreciate. Did the past financings include warrants? When companies do these private placements to raise capital, typically they'll offer what's referred to as a sweetener in the form of a warrant, either a half warrant or a full warrant. Well, you want to know that because down the road, when that paper becomes free trading after the typical 4-month hold time, there'll be some selling into that, and they call that a warrant overhang. So you want to know the dates of when those warrant expires, and these are questions you can ask the company, and they should know the answers to right off the bat. And if not, it's normally in the press release. Whenever a company puts out a press release that they closed a private placement, it'll say these shares are subject to the 4-month hold period, normally expiring on X, whatever the date is, and you want to make note of that in your file for that company. That's the same company, company A and B in the previous example. Now it includes fully diluted. So I added the warrants in there, and you see the company A that had a tighter share structure still only has 52 million shares outstanding fully diluted. But the company that had 130 million shares outstanding also had 50 million warrants outstanding. And so when you get to nearly 200 million shares outstanding on a 6-cent company, that's a definite red flag for me. I want to see fewer shares outstanding for sure. I just throw these funny things in here. When I see a company like Company B in the previous example, I would say, well, you're all out of whack, man. Your share structure is all out of whack. This is the second question. We want to know, what exactly is it that you guys want to do? There's many various stages in the resource space. There's exploration, there's development, there's prospect generation, there's streaming companies, there's producers and mid-tiers. You really want to hone in on what exactly is the goal of your company, why and what are you going to do with my capital when I give it to you? Where in the cycle are you? So this is a fact. Only 1 in 1,000 targets is going to become a mine. And so if you're looking at a company who says they're in the exploration stage and they're looking to make a discovery, if they're talking about selling this project and turning it into a mine, well, it's probably a bit premature to be talking about things like that. So make sure they're specific about exactly what it is they want to execute and what they're going to do with your capital. And what they're going to do with your capital that's going to drive value. So if they're an explorer, you want to say, well, how many drill holes are you going to put in? And when are those drill holes going to be put in? And when do you expect to have them assayed? And when do you expect to have results out? How is my capital as a shareholder going to translate into catalysts that you're going to produce as the company I'm investing in? And this is a chart. It's frequently attributed to Brent Cook. I'm not sure if he was the first one who did it or not, but you want to know where in this cycle the project that you're considering investing in is. If it's early in the cycle, pre-discovery, if it's exploration, that's typically a time, if they do in fact make a discovery, that the stock can ramp up quickly because it goes from having no asset to potentially having an asset or a resource. And then, once it develops the resource and goes into the permitting stage, it becomes a little bit less attractive. Again, some of this stuff is just human nature, right? So once they make a discovery that's really exciting, the stock goes up, and they start to prove it, and they get a 43-101 resource, and we learn how economic it is, and that's also exciting. But then you get what's referred to as the orphan period on this slide, where they go into permitting, and they're getting ready to develop it. They're getting ready to develop it, and they're waiting for permits, and it's just inherently not as quote unquote sexy of a story. And so you need to be mindful of that as an investor, because lots of things in life come down to herd mentality and groupthink, and this has been the proven life cycle of not only a mining company but of its stock and its valuation. So be mindful where it is and where they are, the company that you're looking at, where they are in this cycle. It's okay. Not everything's going to be a mine. If everybody's telling you they have a mine, well, we know that only 1 in 1,000 are going to become a mine. So just be skeptical if they're saying, oh, we have a project that's going to become a mine. It looks really great. The infrastructure's in place. This is how we're going to exit. It's not quite that easy. It's just I'm telling you just to be skeptical. This is the last question. Do you have the expertise to do what you say? So they've passed the test of the share structure, and they've passed the test of explaining what they're going to do with your shareholder capital and why and what the goal of their project is. Well, can you do what you say? And I always just make up an example on the spot. So let's say a company is exploring for gold in Quebec. Well, if their team is staffed with people who have primarily expertise in developing mines in South America, that might be one red flag. You want to see a track record of management that has done what they're doing before, right? So I would like to see maybe some management or board members that have found gold in Quebec before, just as one arbitrary example. And how much of their attention is on this project? So, red flags, we talked about share structure, but a lot of people, and I don't want to demonize Vancouver, but you'll hear about, Vancouver deal guys, right? And the guy who's CEO of company A is also, a director of company B and C and consults for company E. And, oh, by the way, have you heard about this new deal that I'm pursuing? For me, I want your attention on the project that I'm investing in. I'm investing in you as a management team, and I'm investing in the project that you're pursuing. And if you have 4 or 5 other things going on, how much of your attention is really going to be on the project that I'm investing in? So I think you need to evaluate management at all levels, from their track record to what they're saying they're going to do now, and how many other plates they have spinning, because one of those plates, in my experience, is going to drop. And I talk about all of this from personal experience, because as a newsletter writer, it's tough to get sucked into the sexy stories, and you're always looking for things to write about. And I'll be honest, when I first started writing about the resource space, it's been nearly 10 years ago now, you take your lumps, and you come to find out that not every company does what they say they're going to do, and in fact it can be more nefarious than that. They could be using you, and in this case me, as to provide liquidity. If I write up a stock and I send it out to Outsider Club that has 300,000 people on it, well, that creates a lot of volume. And you have to think, well, why does the company want to create volume? Is it because they want to sell their shares? Going back to the cheap paper slide from the first question, I don't want to be creating volume for companies to sell their stock, into the volume that I create. And so I spend a lot of time on these questions figuring out, I'll go back to the first question, who owns all the cheap paper? There is something I omitted to say on that first question, and that's, if they do have cheap paper, it's one thing. Everybody likes to have 5-cent shares or 10-cent shares, but really look if they've also put up money at higher prices. And I think this is a really important detail. I'm sorry I didn't cover it on the first slide, but if they do have 10-cent shares and they're raising money at 60 cents, well, are you investing the same amount of money at 60 cents that you did at 5 cents? Or are you just letting other people put in their capital at this higher price now? You really want people who believe enough in the project to say, well, I'm going to put in an equal amount of money at 60 cents that I did at 5 cents, so I'm not diluted out of my position because I believe that much in the project. So just in a wrap-up slide here, you want to look for good people who have done what they're doing now before and have done it successfully, that have provided value to shareholders in the past, that have had success stories in the past where all people made money, not just the first people in the door. Tight share structures that allow the price to increase. The fewer shares out, the better. As the asset is de-risked and as the asset grows and as the asset is proven, it's fine to have a higher share count, but that needs to be backed by something real in the ground. You can't start off looking for something with a share structure that's out of whack, as I had on that one slide, because it just doesn't afford the opportunity to build a real company. It becomes more of a paper flip deal at that point. And that's pretty much what I just said, a plan to actually add value through serious exploration and development. I want to invest in real companies that are doing real things in real jurisdictions with real people. I don't want to invest in paper flip deals or promotes as they call them, right? Oh, this is a great story to tell. Well, I like great stories, but I like great assets and share structure and people better. That's all I have for today. We're just about right on time there. So some companies that I've talked about yesterday that have booths here is, one is Sky Harbor Resources. They pass muster on all these questions that I've just presented to you. And Stephen Quinn is in the back of the room with Midas Gold. I always point him out if he comes to my presentation. Feel free to go ask him about Midas Gold. Sean Thompson is sitting right here from Atlantic Gold, who I also cover in my newsletter. Atlantic Gold has the only fully permitted, financed, under construction open pit gold mine in Canada. It's in Nova Scotia. We were just talking at lunch about the trend recently of majors buying out quality junior companies in Canada because they're just risk averse at this point. The gold has been stuck in this channel, $1,150 to $1,300, and they're looking for projects in safe jurisdictions. We just saw Integra or Eldorado take out Integra for a 50% premium. Eldorado's primary assets were in Greece and Turkey, and you can see how they're diversifying into Canada. So look at jurisdictions that are safe. Midas is in Idaho. Atlantic Gold is in Nova Scotia. Contact information is up there. That's my personal email address. I respond to everything I get. Outsider Club is free to sign up for. It comes out 7 days a week. And Resource Stock Digest is also a free service where we sort of really take deep dives into interviewing these companies. And my partner, Gerardo Del Real, if you go to that site, you'll see that his interview style really peels back the layers of all these questions I've been discussing with you today. He and I have very similar philosophies. And so when he interviews managements of these companies, he's always getting to the heart of the matter of what are you doing with my capital? How are you advancing the project? Are you keeping the share structure tight? How much cash do you have left in the bank? When are you going to have to raise money again? At what prices do you plan to do that? What are the catalysts for the next 6 months? These are all very, very important things. That's all I have for today. I have cards up here. I'm welcome to answer questions. Please talk to the companies that I mentioned. They're what I like to consider the wheat from the chaff, and that's where I'd spend my time investing. Thanks, guys. I appreciate it.